Hi and welcome to IFA Investment Showcase. I'm your host, Sarah Kendall. I'm joined today by Teiki Beneviste, Head of ARA's Australia Management, and Samantha Milner, Partner and Lead Portfolio Manager for ARA's Global Liquid Credit, and Head of US Liquid Credit Research at the LA-based ARA's Management. We'll be discussing some of the challenges and opportunities for investors arising out of this once-in-a-century global pandemic. While interest rates remain at record lows, global economies begin to reopen with a lot of government stimulus behind them, and the risk of a possible inflationary period looms. Teiki and Sam, thanks for joining me today.
Thank you, Sarah.
Thanks.
Now, obviously, the COVID-19 pandemic sent shockwaves through the financial markets globally, hitting both large corporations and small businesses. How have you been able to navigate the crisis and capitalise on investment opportunities resulting from the pandemic? Teiki, I'll come to you first.
Yeah, thanks. So I think when you look back at 2020, two of the key factors of success for us were our ability to manage downside risk and then use relative value investing to capture the opportunity. So that really helped us navigate the crisis and then deliver outstanding risk-adjusted returns to our investors. I mean, when you think about the markets we invest in, they represent a $5 trillion opportunity set and include things like broadly syndicated loans and high yield bonds. And those markets during the 2020 COVID crisis, experienced double the level of defaults that they would not really experience on an annual basis since the GFC. So you're talking about 5% for broadly syndicated loans and around 9% for high yield bonds. So I think that really highlights the importance of credit selection, superior credit selection to avoid defaults. And in the ARA's Global Credit Income Fund, for example, we experienced no default in this fund since inception in May 2020. Then, starting from this very strong base of fundamental credit selection, trying to avoid defaults, we then look at the opportunity set, and these different asset classes really show different return profiles or recovery profiles, not just between them, but also across rating bands, across industries. And so our ability to dynamically allocate to where we thought we saw the best relative value across those asset classes really helped us capture those opportunities.
Great. And I guess, if we're talking about sort of relative value opportunities, Sam, can you tell us a bit more how you capitalize on these opportunities in such a challenging market?
Sure. Teiki framed it well, in terms of how active and nimble we were in 2020, which really led us to be successful. So in the beginning of COVID, we saw the most value in the higher quality parts of credit, notably high grade corporate bonds and BB loans. And we were very defensive in our industry positioning. As credit spreads tightened, really given that flood of fiscal and monetary stimulus, we took profits in the high grade corporate debt and we rotated into investment grade structured credit as this market was really lagging the recovery from a price perspective. So essentially we were swapping for similar risk and rating by picking up yield and discount. And then we got more conviction on the economy reopening, especially around the vaccine news, later in 2020. So we started buying more assets in sectors like basic materials and aerospace and reduced duration by selling high yield bonds and swapping into loans, as we really saw this potential for rising rates as we got this cocktail of the vaccine and unprecedented stimulus. So we thought it was more attractive on a relative value basis, given the floating rate nature, discount to par, and security. So all in all, we've done in the past cycles over the last 20 years, we were very tactical and active in terms of rotating across asset classes, ratings, industry, and credits, seeking the best risk-adjusted returns, and focusing on current income and downside protection.
And as you said, obviously, we've got sort of unprecedented levels of, fiscal and monetary policy flooding the market now that we're into this sort of second phase of the pandemic with sort of global reopenings. How do you view sort of the outlook for inflation and the potential impact on leveraged credit markets?
It's pretty incredible the amount of support that was injected. And of course, the pandemic itself was unprecedented. So we do think that it was necessary, and we think it's going to have a positive impact on the leverage credit market as the economy recovers extremely fast. But you raise a good point. I mean, of course, inflation is a key risk and it's top of mind, and it's what all the investors are talking about. But our base case is that it's mostly transitory, and it shouldn't be a surprise that the spikes in categories that are usually smaller parts of CPI, like used car prices, that reflects supply bottlenecks and a snapback in demand. And of course, there's also a focus on labor and wages. And we do expect there to be pressure in the near to medium term in terms of recruiting people to get back to work, incentivizing them. But long term, we see a lot of deflationary impacts on labor as you think about automation. So look how quickly we adapted to working from home or going to a restaurant, contactless. So we've really been able to automate, which should offset labor price increases in 22 and beyond. And we think the Fed will be patient and gradually taper, which is strong for our markets to have this gradual increase, at the same time, recovering. But of course, if there's a taper tantrum like we saw in 2013, there will be volatility. It's not our base case, but just think back in 2013, how quickly high yield did snap back. And then also loans really didn't trade off that much. So not our base case, but there could be volatility if the Fed doesn't telegraph. Taper.
Yeah, absolutely. I think that's really an important point around automation and sort of the degree to which it's been implemented in businesses to a much higher sort of level than it was pre-pandemic. I guess, if we're looking at the outlook for the vaccine rollout, we've got sort of 176 million people fully vaccinated worldwide, 450 million that have had at least one dose. So it does appear that we're inching closer to a post-COVID world. What's your team's sort of economic outlook in a post-COVID environment? Where are the opportunities going to be?
Yeah, we're really constructive. I mean, we look at a lot of credit card data and conversations with management teams across our platform, and we have seen a pickup in spending across gyms and airlines, and even conferences, are picking up. And even in states with lower vaccination rates, we're also seeing spending has been picking up. So we may not have to even wait for a full vaccination, to see that full recovery. And with GDP set to increase, 6 to 8%, we see this strong fundamental recovery, but with low defaults. So it's a pretty good environment. Now, a lot of that is priced in, and that's why we're not reaching for broken cap structures or industries with secular challenges like movie theaters and retail and parts of retail. But really, it's a great environment to get 4% current yields without really taking duration risk and default risk.
Well, I think that's a good opportunity to talk a little bit about the fund. So, Teiki, I'll come to you. And what was the genesis for launching the ARA's Global Credit Income Fund, and what sort of issues are you trying to solve?
Yeah, so the first challenge is one that investors will be very familiar with, which is what you can call the income conundrum. In Australia, cash rates are at historical lows, and over the last 10 years, really bond yields across the globe and in Australia have compressed significantly. If you then look at all the way out to the other side of the risk spectrum, the bank dividends during the crisis have been cut, showing that there's a lot of uncertainty around those if you rely on that type of income. And the result is really that investors potentially are reaching out, down the risk spectrum in those traditional asset classes and really adding more of the same risk in their portfolios. The second challenge is really about structural shifts that have happened in capital markets and that have resulted in dislocations happening more often, being more frequent, but also being shorter. So it's a challenge, but it's also an opportunity at the same time. If you think about that for a second, you look at the GFC and you look at the high yield bond market, and high yield spreads blew up during the GFC and went above 500 basis points, and it took them about 28 months to recover. So you had 28 months to reposition your portfolio and grab the opportunity. Since the GFC, you've had more occurrence of these sorts of dislocations, so credit spread going above 500 basis points, but then the time to recovery has been shorter, so you had less time to reposition. One of the extreme examples that we've experienced recently in the fourth quarter of 2018, you've had 11 days basically to reposition and grab the opportunity. During COVID, you had about 6 months. So being nimble and being able to shift around your portfolio and grab relative value is quite important in our mind. So that's how we created the ARA's Global Credit Income Fund. It's a dynamic income strategy made for those shifting markets. but that also is, we believe, should be used in portfolios as a yield enhancer and a diversifier, as it accesses attractive levels of current income and asset classes that showcase this attractive level of current income, but also have downside protection attributes that we find really attractive.
And where do you sort of generally look for those opportunities in terms of, the higher levels of income to counteract the sort of income conundrum that you were talking about, and also downside protection, given that markets have been more volatile in the last few years?
Yeah, I mean, that's a very good question. What we are looking at is high quality corporate debt and structured credit. This is where we focus, and what we're trying to deliver in this fund is returns of gross returns of 3 to 4% above the Osborne Bank Bill Index. So we'll be looking at those asset classes that have yields between 2.5% and 5%, and also exhibit downside protection benefits such as floating rates and being high up in the capital structure, so senior secured loans, for example. And so we'll be looking at things like corporate bonds, syndicated loans, and alternative credit. These are the types of assets we would be looking at.
And Sam, in terms of the risks that investors need to be aware of, what are some of the risks that you're taking by investing in those sorts of asset classes, and how do you mitigate those as a manager?
I like how Teiki has been talking about that focus on downside protection. And this is minimizing credit default risk and also dampen volatility. And in Ares, we have this incredible platform, over $200 billion of assets, and a process which really minimizes defaults. This credit selection is very critical. Just one example, we have the largest private debt business and nearly $100 billion in a large private equity business. And that gives us information on over 2,000 credits. So we can see trends on sectors or margins as one example. As we think about inflation, is very topical. But we have real-time information versus in our liquid universe in terms of loans and bonds and structured credit. It may take 3 months to get information in terms of the underlying credit. So it really comes down to getting that unique advantage as it relates to diligence. And also a lot of those middle market companies in private debt grow up into this larger, universe that we invest in. And so we have all that, 10, 20 years of monthly financials. We also have a great quant team called Quantitative Risk and Research, QR squared. They really focus in terms of measuring risk from both a top down and a bottoms up. And they work with our 60 analysts in our corporate credit business, as well as alternative credit business, which is really the biggest team on the street, and looking how we are managing risk across our portfolios. And finally, our alternative credit teams, they can look through every CLO and see every credit and every trade that each manager is doing. So it provides great color in terms of the micro and the macro. So takeaway is we have a repeatable and a proven process that we've been honing for over 20 years and really leading to the best risk-adjusted returns and under defaulting the market. Teiki talked about zero defaults in this fund, which is very critical. And across the platform at Ares, less than 1% of defaults in leveraged loans and high yield, which compares very well to the industry, around 6% in 2020. So we're very proud of that.
Yeah, absolutely. That's a great stat to sort of be able to speak to. And Teiki, you mentioned leverage loans sort of as part of the strategy, and as we enter a potentially rising rate environment, we've seen a renewed interest in that asset class, a few different sort of funds and strategies launching around this space. How do you differentiate yourselves as loan market investors?
Yeah, I think we have to go back to what Sam was talking about, which is the power of the platform. Because, on top of this information advantage that Sam has mentioned, which is, giving us that, specific insights into companies, we believe that we can also generate better allocations, get access to better allocation to those deals in the liquid market, and better economics. And that's really by capitalizing on what we're seeing is basically a convergence between broadly syndicated loans and corporate direct lending. And in both cases, Ares is a leader in those markets. And so as you see your traditional middle market companies grow and graduate into the broadly syndicated loan market, we're able to capitalize on the opportunities that generates for us. So as an example, these additional economics, they come in the form of original issue discounts or arranger fees. And these things can add up to 700 basis points that are then fully passed on to the investors in the fund. So that for us, that's quite key in terms of differentiating ourselves. On top of the information benefits that we get from the platform, we also get those allocations and better economics.
And Sam, on top of loans, what other opportunities are you seeing in credit markets today, and how are you positioned in the fund to capitalize on those?
As we think about, in addition to loans, which I talked about before, you look at short duration high yield, and really investment grade structured credit stand out as a good place where you can get 2 to 4% stable current income and not take duration risk. And again, you can also be defensively positioned from a sector perspective, and we don't have to swing for the fences to get all in 4% yield, and then with a little bit of upside as well from a price appreciation standpoint.
Awesome. Well, thanks so much to Teiki and Sam for joining us today for this interesting discussion.
Thank you, Sarah.
Thank you.
And the fund is available via Ara's distribution partner, Fidante Partners in Australia. For more information about the fund or Ara's, please contact your local Fidante Partners BDM or visit www.arasmanagement.com.au. That's today's show. Thanks for joining us.